Investing is a journey toward financial well-being. It's about making your money work for you, growing your wealth over time. But like any journey, it's crucial to have a solid plan. That's where asset allocation comes in. It's the cornerstone of smart investing, the bedrock upon which you build your financial future. In simple terms, asset allocation is the strategic distribution of your investment capital across various asset classes. These classes typically include stocks, bonds, and cash. Each asset class has its own unique risk and return characteristics. By spreading your investments across these classes, you're not putting all your eggs in one basket. You're diversifying your portfolio, reducing the impact of any single investment's performance on your overall wealth. Think of it like this. You wouldn't bet your entire life savings on a single horse race, would you? The same principle applies to investing. Diversifying your portfolio helps you manage risk and increase the likelihood of achieving your financial goals. It's about creating a balanced approach, one that can weather market fluctuations and keep you on track for the long haul. The beauty of asset allocation is that it's not a one-size-fits-all approach. It's a personalized strategy that takes into account your individual circumstances, your risk tolerance, and your investment horizon. Whether you're a seasoned investor or just starting your journey, understanding and implementing a sound asset allocation strategy is essential for achieving lasting financial success. Diversification is a fundamental principle in investing, often referred to as not putting all your eggs in one basket. It involves spreading your investments across different asset classes to reduce risk and enhance potential returns. The idea is that if one investment performs poorly, others may perform well, thus mitigating the overall impact on your portfolio. Imagine investing all your money in a single stock. If that company faces unexpected challenges, your entire investment could be jeopardized. However, if you diversify by investing in multiple stocks across various sectors, the impact of one company's downturn would be lessened. If one sector experiences a decline, others may remain stable or even thrive. Diversification works because different asset classes tend to behave differently under various market conditions. For example, when stocks are soaring, bonds may be more subdued. Conversely, during economic downturns, bonds might provide stability while stocks falter. By including a mix of asset classes in your portfolio, you create a balance that can help navigate market volatility. It's important to note that diversification doesn't guarantee profits or eliminate risk entirely. It's about managing risk intelligently, reducing the likelihood of significant losses. By spreading your investments wisely, you're creating a more resilient portfolio that can better withstand market fluctuations and keep you on course toward your financial goals. Real-world examples illustrate the power of diversification. Consider the dot-com bubble of the late 1990s. Investors heavily concentrated in technology stocks faced substantial losses when the bubble burst. However, those with diversified portfolios, including bonds and other asset classes, were better able to withstand the downturn. Similarly, during the 2008 financial crisis, diversified portfolios proved their worth. While stock markets plummeted, investments in bonds and other less volatile assets provided a cushion, mitigating overall losses. This real-world experience underscores the importance of diversification in navigating turbulent market conditions. The key takeaway is that diversification acts as a shock absorber, reducing the impact of market swings. It's not about avoiding losses altogether, but rather about minimizing their severity. By spreading your investments, you're creating a buffer that can help protect your portfolio during times of uncertainty. These examples highlight the critical role diversification plays in preserving capital and achieving long-term financial success. It's not just a theoretical concept, it's a practical strategy that has proven its value time and again. Asset allocation is not a one-size-fits-all approach. It's a personalized strategy that should be tailored to your individual circumstances, primarily your risk tolerance and investment horizon. Risk tolerance refers to your comfort level with market fluctuations. Are you comfortable with potentially higher returns, but also the possibility of greater losses? Or do you prefer a more conservative approach, prioritizing stability over potential gains? Your investment horizon is equally important. How long do you plan to invest your money? If you're investing for a long-term goal, such as retirement, you can afford to take on more risk. A longer time frame allows you to ride out market volatility and potentially benefit from long-term growth. Conversely, If your investment horizon is shorter, a more conservative approach might be appropriate. Understanding the characteristics of different asset classes is crucial for effective asset allocation. Stocks, known for their growth potential, carry higher risk but also offer the possibility of significant returns. Bonds, on the other hand, are generally considered less risky, providing stability and income. Cash, the most conservative asset class, offers liquidity but typically lower returns. By carefully considering your risk tolerance, investment horizon, and the characteristics of each asset class, you can create an asset allocation strategy that aligns with your financial goals and personal circumstances. Creating a diversified investment portfolio involves a systematic approach. Here's a step-by-step guide to help you build a portfolio that aligns with your financial goals and risk tolerance. 1. Determine your risk tolerance. Assess your comfort level with market fluctuations. Consider factors such as your age, financial situation, and investment goals. 2. Define your investment horizon. Establish the time frame for your investments. Are you investing for the long term, like retirement, or a shorter term goal? 3. Select asset classes. Choose a mix of asset classes based on your risk tolerance and investment horizon. This typically includes stocks, bonds, and cash, but can also include other asset classes such as real estate or commodities. 4. Allocate assets. Determine the percentage of your portfolio to allocate to each asset class. This is where your risk tolerance and investment horizon come into play. A more aggressive investor with a longer horizon might allocate a larger portion to stocks, while a more conservative investor with a shorter horizon might favor bonds. 5. Choose investments within each asset class. Select specific investments within each asset class. For example, within stocks you might choose individual stocks, mutual funds, or exchange-traded funds, ETFs. 6. Review and adjust. Regularly review your portfolio's performance and make adjustments as needed. This includes rebalancing, which we'll discuss in the next section. By following these steps, you can build a diversified investment portfolio that is tailored to your individual needs and goals, setting the stage for long-term financial success. Once you've established your asset allocation and built your portfolio, the work isn't done. Markets are constantly fluctuating, and these movements can shift the balance of your portfolio over time. This is where rebalancing comes in. It's the process of adjusting your portfolio to maintain your desired asset allocation. Imagine you started with a 60-40 stock-bond allocation. If the stock market experiences a significant rally, your stock allocation might increase to 70%, while your bond allocation drops to 30%. This shift alters your intended risk profile, potentially exposing you to more volatility than you're comfortable with. Rebalancing involves selling a portion of the overperforming asset class, in this case, stocks, and reinvesting the proceeds in the underperforming asset class, bonds. This brings your portfolio back to your target allocation, ensuring that your risk level remains aligned with your goals. Rebalancing frequency varies depending on market conditions and your personal preferences. Some investors rebalance annually, while others do so more frequently, or only when their asset allocation deviates significantly from their target. The key is to establish a rebalancing strategy that works for you and stick to it. Rebalancing helps maintain discipline, ensuring that your portfolio stays on course and continues to reflect your risk tolerance and investment objectives. Regular rebalancing is an essential part of maintaining a healthy and well-performing investment portfolio. Asset allocation is the cornerstone of successful investing. It's about strategically distributing your investment capital across different asset classes to manage risk and enhance potential returns. By diversifying your portfolio, you're creating a more resilient financial foundation that can weather market fluctuations and help you reach your goals. Remember, asset allocation is not a one-size-fits-all approach. It's a personalized strategy that should be tailored to your individual risk tolerance, investment horizon, and financial goals. By understanding the characteristics of different asset classes and carefully constructing your portfolio, you can create a roadmap for long-term financial success. Whether you're a seasoned investor or just starting your journey, embracing the principles of asset allocation is essential for navigating the complexities of the financial markets. It's about making informed decisions, managing risk effectively, and staying the course even when markets become turbulent. By implementing a sound asset allocation strategy and consistently rebalancing your portfolio, you're putting yourself in the best position to achieve your financial goals and secure a brighter financial future. Remember, the journey to financial well-being starts with a solid plan, and asset allocation is that plan's foundation. If you found this video helpful, please like and subscribe to our channel for more insightful content on investing and personal finance.